Okay. All right. Good evening, everybody. Yes, Happy New Year, everyone. I do welcome you to the very first session for financial reporting, CPA exam preparation, intended for the June 2021 diet. I'll share with you the course outline. When we meet during the physical class, we shall be able to go through the overview of the entire syllabus content. For today, we are going to start looking through the very first topic, known as the conceptual framework. The conceptual framework for financial reporting comes all the way from 1989 and it has undergone several changes over time. The current conceptual framework is based on the revised 2010 conceptual framework. So this is the conceptual framework as of the current status as per the 2021 IFRS publication. We are aware that this conceptual framework was adopted as a means of harmonizing financial reporting between the Financial Accounting Standards Board, FSB, that is in the USA, that was governing the board in the America, and also the ISB, which is the International Accounting Standards Board, where Uganda falls part in the international framework for financial reporting. That is the board responsible for issuance of IFRSs through the IFRS Foundation. Well, we are starting very quickly in a minute, and we are starting by describing what the conceptual framework is. The conceptual framework describes the objective and the concepts of general purpose financial reporting. The purpose of the conceptual framework is to assist the ISB to develop IFRS standards that are based on consistent concepts. IFRS is International Financial Reporting Standards. Okay. The other purpose is to assist the preparers to develop consistent accounting policies when no standard applies to a particular transaction or other event, or when a standard allows the choice of accounting policy, and also to assist all parties to understand and interpret the standards. So the conceptual framework is very, very important in terms of preparing the financial statements. All the IFRSs which are developed must be consistent with the conceptual framework. And we are saying that the conceptual framework also assists the preparers who are not sure of which IFRS or which accounting standard to adopt in a given accounting transaction. It helps such users to rely on the conceptual framework in order to come up with useful, reliable, comparable financial statements. What is the objective of general purpose financial reporting? Okay, we have just seen that the purpose of the conceptual framework is to assist the ISB in developing the IFRSs, assist the preparers in developing consistent accounting policies where no standard applies in a given transaction or event, and also assist all parties to understand and interpret the standards Now, nothing in the conceptual framework should override any standard or any requirement in a standard. Objective of general purpose financial reporting. The objective of general purpose financial reporting is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions relating to providing resources to the entity. Those decisions involve decisions about buying, selling, or holding equity and debt instruments, providing or settling loans and other forms of credit, exercising rights to vote on, otherwise influence management's actions that affect the use of the entity's economic resources. Having talked about economic resources, what are the economic resources vis-a-vis the the claims? Information about the entity's economic resources and claims help users to assess the liquidity and solvency of the entity. Then this information can help users to assess the management stewardship of the entity's economic resources. Now, having learned what economic resources are, then we need to understand changes in economic resources and claims. These result from the entity's financial performance and from other events or transactions such as issuing debt or equity instruments. As the entity performs or as the entity transacts during the year, there are changes in economic resources. So those changes are the ones we are referring to here. Sometimes the entity may simply issue debt or equity instruments. So there are no transactions during the year. Maybe there's no trading during the year, but it has sold shares, like the recent stock listing by MT and Uganda. That was issuance of equity instruments on the stock market. It could be issues to do with the debt instruments. Okay. So information about the reporting entity's financial performance helps users to understand the return that the entity has produced on its economic resources. Return is like a profit. Financial performance reflected by accrual accounting. Now, the conceptual framework sincerely supports the accrual concept of accounting. Accrual accounting depicts the effects of transactions and other events and circumstances on reporting entities' economic resources and claims in the periods in which those effects occur, even if the resulting cash receipts and payments occur in a different period. Okay. So the accrual principle is such that you need to recognize transactions in a period in which they occur or they relate, rather than in a period in which the actual payment is made or the actual receipt of cash is effected. So this is a better way of assessing future and past performance than information solely about cash receipts and payments during that period. Financial performance is reflected by past cash flows. Information about the reporting entity's cash flows during the period also helps users to assess the entity's ability to generate future net cash inflows and to assess management stewardship of the entity's economic resources. Changes in economic resources and claims which are not resulting from financial performance. Those ones I already talked about them. That is issuance of debt and equity instruments. Good. Again, a third background. Let's go to qualitative characteristics of useful financial information. This is the second chapter in the conceptual framework of financial reporting. Okay. The conceptual framework is comprised of 8 chapters, which we are going to look at today. So we are now on the 2nd chapter. As per the framework, if financial information is to be useful, then it must be relevant and faithfully represent what it purports to represent. Okay. The usefulness of financial information is enhanced if it is comparable, verifiable, timely, and understandable. You have seen these concepts before in your first paper, that is financial accounting, when you are looking at qualitative characteristics or useful financial information, where you studied that there were 2 categories: fundamental characteristics and then enhancing. So the fundamental ones, you noted that there were 2: relevance and faithful representation. Okay. Then the enhancing ones included verifiability, timeliness, understandability. So that is derived from 2nd chapter of the conceptual framework. What is relevance? Relevant financial information is capable of making a difference in the decisions made by users. Financial information may be capable of making a difference in a decision, even if some users choose not to take advantage of it or are already aware of it from other sources. So financial information is capable of making a difference if it has predictive value, confirmatory value, or both. These are not new concepts to you. You have seen this before. It is a matter of emphasis. Financial information has predictive value if it can be used as an input to processes employed by users to predict future outcomes. Financial information with predictive value is employed by users in making their own predictions. And financial information has confirmatory value if it provides feedback about previous evaluations. Okay, materiality. Information is material if omitting, misstating, or obscuring it could reasonably be expected to influence decisions that the primary users of general purpose financial reports make on the basis of those reports, which provide financial information about a specific reporting entity. So materiality is entity specific. You cannot have industry materiality. So materiality depends on the size of the business and the nature of transactions with the business. Faithful representation. Financial reports represent economic phenomena, so in words and numbers. And financial information must not only represent relevant phenomena, but it must also faithfully represent the substance of the phenomena that it purports to represent. Well, in simple language, we are saying that the financial reports should not only be relevant, but they should have a substantial economic effect. They should faithfully represent the transactions in the financial statements. Okay. In most cases, the substance of an economic phenomenon and its legal form are the same. For instance, if I've sold my items, the legality is that the transaction sale has taken place. And in substance, there is revenue. So in effect, the legal form and the substantial form are the same. But you may have cases where the legal form is different from the substance of the form. So in circumstances where the legal form is different from the substantial form, for financial reporting purposes, we shall always take the substantial form. Okay. So to be a perfect, faithful representation, a depiction would be complete, neutral, and free from error. We have seen these concepts before. Complete, that means there should be all facts about the transaction included. And then neutral implies they shouldn't be biased. Okay, they shouldn't be biased. Free from error. Information must be accurate. However, it does not mean that some level of inaccuracy may not exist, especially where judgment is needed in circumstances like estimation of depreciation, amortization, impairment charges. So there are certain considerations where a certain level of inaccuracy may be tolerated. However, the framework is such that the information presented should be free from error. Enhancing qualitative characteristics. Comparability, verifiability, timeliness, and understandability are the qualitative characteristics. Okay. Qualitative characteristics that enhance the usefulness of information that is both relevant and provides faithful representation of what it purports to represent. Wow, that was an overview of the qualitative characteristics of financial statements. And they are basically two. You have the fundamental characteristics and then the enhancing characteristics. The fundamental characteristics are those ones known as relevance and faithful representation. All these you studied in your financial accounting paper 1. Okay. In your financial accounting paper 1. All right. The cost constraint and useful financial reporting. Cost is pervasive constraint on the information that can be provided by financial reporting. Providers of financial information explain most of the effort involved in collecting, processing, verifying, and disseminating financial information. But users ultimately bear the costs in the form of reduced returns. So if you are to achieve useful financial reporting, you'll need to employ a qualified accountant who is aware of the financial reporting standards. You'll need to employ a qualified auditor who will provide assurance over the financial reports. So those are costs which go through your profit or loss, and the residual return to the owners of the business is ultimately reduced. So before you think of useful financial reporting, you need to compare the costs and the benefits of achieving useful financial reporting. So the cost constraint is a concept under the financial framework or the conceptual framework for financial reporting. It is very, very important that the preparers of financial statements or the owners of the business take into account the cost constraint concept when preparing the financial statements. Okay. Okay, so financial statements and the reporting entity. The objective of financial statement is to provide financial information about the reporting entity's assets, liabilities, equity, income, and expenses that is useful to users of financial statements in assessing the prospects for future net cash inflows to the reporting entity and in assessing management stewardship of the entity's economic resources. Reporting period. The financial statements are prepared for a specified period of time, which is known as the reporting period. That could be 1 year. So to help users to identify and assess changes and trends, financial statements also provide comparative information for at least one preceding reporting period. So the reporting period could be 1 year, could be 6 months, but there should be a preceding reporting period for each subsequent set of financial statements prepared. They should be compared with the financial statements of a preceding period. That is the period before the current period. Going concern assumption. Financial statements are normally prepared on the assumption that the reporting entity is a going concern and will continue operation for the foreseeable future. Hence, it is assumed that the entity has neither the need nor the need, nor the need to enter into liquidation or to cease trading. So they don't need, they have neither the need to enter into liquidation nor the need to cease trading. So if such an intention or need exists, what if it exists? They have the need to liquidate or to stop trading or cease trading. Then the financial statement may have to be prepared on a different basis. And if so, the entity must disclose the basis used. For instance, the breakup basis. That is, if the financial statements are not prepared on the going concern assumption. The reporting entity. A reporting entity is an entity that is required or chooses to prepare financial statements. Reporting entity can be a single entity or a portion of an entity, or can comprise more than one entity. A reporting entity is not necessarily a legal entity. Okay. So, elements of financial statements. This is now the 4th chapter. Okay. The 2nd chapter was qualitative characteristics, and the 3rd chapter was financial statements and the reporting entity. Now the 4th chapter is elements of the financial statements. We all know the elements of financial statements are assets, liabilities, incomes, expenses, then equity. Now, what are the definitions? Asset. An asset is a present economic resource controlled by the entity as a result of past events. As simple as that. A present economic resource controlled by the entity as a result of past events. An economic resource now is a right that has the potential to produce economic benefits. Economic resource is a right that has the potential to produce economic benefits. Conditions of an asset are right to produce economic benefits and control. So there are 2 conditions for you to recognize an asset. Is there a right to produce economic benefits, and is there control? These conditions are embedded in the definition. A present economic resource. A present economic resource controlled by the entity as a result of past events. Now, economic resource on its own refers to the potential to produce economic benefits. So that means you are looking at the potential to produce economic benefits and then control. A right. When you have an asset, you have a right. So a right that has the potential to produce economic benefits is one condition for an asset. The second condition is control. So 2 conditions to recognize an asset. The right that has the potential to produce economic benefits, which is an economic resource. And the second condition is control. What's a right? Rights that have the potential to produce economic benefits include There are those that correspond to an obligation of another party, and there are those which do not correspond to an obligation of another party. The ones which correspond to an obligation of another party include rights to receive cash. You hold an asset, you have a right to receive cash. Assuming you have an investment. That investment, when you sell it, you receive cash. Right to receive goods or services. Okay. Right to exchange economic resources with another party on favorable terms. Such rights include forward contracts to buy an economic resource on terms that are currently favorable, or an option to buy an economic resource. Rights to benefit from an obligation of another party to transfer an economic resource if a specified uncertain future event occurs. Then those which do not correspond to the obligations of another party include the rights over physical objects, such as property, plant, and equipment, or inventories. Examples of such rights are a right to use a physical object or a right to benefit from the residual value of a leased object. Maybe a right to use intellectual property. Okay, potential to produce economic benefits. Now, for the potential to exist, it does not need to be certain. That means the framework allows for uncertainty. A right can meet the definition of an economic resource and be an asset even if the probability that it will produce economic benefits is low. If you recall, those of you who studied in the old framework, who studied about the old framework, you noted that an asset was recognized only and only if it is probable that future economic benefits will flow to the entity and its cost can be measured reliably. That is how we used, of course, all that has been revised. Now you look at the potential, and we are saying that this potential is not necessarily about probability, the level of probability. High, low, no. Even if it is low, that potential to receive such economic benefits exists. So that is what the board revised. Okay, a right to receive economic benefits can still prevail even if there is uncertainty and even if the probability is low. So we need to organize an asset control. An entity controls an economic resource if it has the present ability to direct the use of the economic resource and obtain economic benefits that may flow from it. Liability. A liability is a present obligation of the entity to transfer an economic resource as a result of past events. For a liability to exist, 3 criteria must be satisfied. The first one, the entity has an obligation. The second one, the obligation is to transfer an economic resource. The third one, the obligation is a present obligation that exists as a result of past events. Okay. Then obligation. An obligation is a duty or responsibility that an entity has no practical ability to avoid. The entity has no practical ability to avoid. That's an obligation. You cannot avoid. An obligation is always owed to another party or parties. The other party or parties could be a person or another entity, a group of people or other entities, or society at large. Okay. Transfer of economic resource. An obligation can meet the definition of a liability even if the probability of the transfer of economic resource is low, just like I told you. Okay. Obligations to transfer economic resource include obligations to pay cash, obligations to deliver goods or provide services, obligations to exchange economic resources with another party on unfavorable terms. Such obligations include, for example, a forward contract to sell an economic resource on terms that are currently unfavorable, or an option that entitles another party to buy an economic resource from the entity. Obligations to transfer an economic resource if a specified uncertain future event occurs. Obligations to issue a financial instrument if that financial instrument will oblige the entity to transfer an economic resource. Okay. Instead of fulfilling an obligation to transfer an economic resource to the party that has the right to receive the resource, entities sometimes decide to do the following. Settle the obligation by negotiating a release from the obligation. Transfer the obligation to a third party. Replace the obligation to transfer an economic resource with another obligation by entering into a new transaction. Okay, the present obligation as a result of past events. The present obligation exists as a result of past events only if the entity has already obtained economic benefits or taken an action. And as a consequence, the entity will or may have to transfer an economic resource that it would not otherwise have had to transfer. Unit of account. This is the right or a group of rights, the obligation or group of obligations, or the group of rights and obligations to which recognition criteria and measurement concepts are applied. Okay. A unit of account is selected for an asset or liability when considering how recognition criteria and measurement concepts will apply to that asset or liability and to the related income and expenses. If rights are separate from obligations, it may be appropriate. Okay, it may be appropriate to group the rights separately from the obligations, resulting in the identification of one or more separate assets and liabilities. Treating a set of rights and obligations as a single unit of account differs from offsetting assets and liabilities. What do we mean by treating? So treating a group of rights and obligations as a single unit of account may provide more relevant information than treating each right or obligation as a separate unit of account if, for instance, those rights and obligations cannot be or are unlikely to be the subject of separate transactions, cannot or are unlikely to expire in different patterns, have similar economic characteristics and risks, hence are likely to have similar implications for the prospects of the future net cash inflows to the entity or net cash outflows from the entity, or are used together in business activities conducted by an entity to produce cash flows and are measured by reference to estimates of the interdependent future cash flows. Note, the benefits of selecting a given unit of account should outweigh the costs, and the resulting information must be more useful. Okay. Before you conclude that I don't have to have several accounts of assets or classes of assets, before you consolidate, bear in mind understandability of the financial statements or the usefulness of the information you are presenting. If adding it together is more useful, well and good. So it's not good to have unnecessary details, but do not leave out useful information. Possible units of account include an individual right or individual obligation, all rights, all obligations, or all rights and all obligations arising from a single source. For example, a contract. Okay. A subgroup of those rights and all obligations, for example, a subgroup of rights of an item of property, plant, and equipment, for which the useful life and pattern of consumption differ from those of other rights over that item. A group of rights or obligations arising from a portfolio of similar items. A group of rights and obligations arising from a portfolio of dissimilar items. For example, portfolio of assets and liabilities to be disposed of in a single transaction. And the risk exposure within a portfolio of items. When a portfolio of items is subject to a common risk, some aspects of the accounting for that portfolio could focus on the aggregate exposure to that risk within the portfolio. Executable contracts. When one talks about executable contracts, this is a contract or a portion of a contract that is equally unperformed. It is a contract which has not been performed. For example, if you work with a company, your contract letter shows that after your 5-year contract, you will get gratuity. But the condition is you get the gratuity after performing the services of employment during the 5-year term. So you have an executable contract. The employer has an executable contract. The contract you hold with the employer has both the rights and obligations, and has not been performed. The employer has the right to receive services from you. It has an obligation to pay you the gratuity, but it has not been performed, so it's an executable contract. And you can't separate the rights from the obligations. You can't. So neither party has fulfilled any of its obligations, or both parties have partially fulfilled the obligations to an equal extent. An executable contract establishes a combined right and obligation to exchange economic resources. The right and obligation are interdependent and cannot be separated. An example is a contract to exchange future salary for employees. So employee services, sorry. Equity. Equity is the residual interest in the assets of the entity after deducting all its liabilities. Incomes and expenses. Income is increases in assets or decreases in liabilities that result in increases in equity other than those relating to contributions from holders of equity claims. Okay. When you get contributions from holders of equity claims, do not amount to income. For example, if the owners give you additional capital to the business, you don't recognize capital as income. Okay. Some circles you find the owners are contributing funds to the circle, and the circle accountant recognizes that as income. That's wrong. Contributions from owners or the holders of the equity claims is not income. The framework clearly defines, the conceptual framework clearly defines income as increases in assets or decreases in liabilities that result in increases in equity other than those relating to contributions from holders of equity claims. Expenses are decreases in assets, increases in liabilities that result in decreases in equity other than those relating to distributions to holders of equity claims. Recognition and derecognition. Now, that is chapter 5 of the conceptual framework. Recognition and derecognition. Chapter 5. Recognition is the process of capturing for inclusion in the statement of financial position or the statement of financial performance, an item that meets the definition of one of the elements of the financial statements. Recognition links the elements, the statement of financial position and the statement of financial performance as follows. In the statement of financial position, at the beginning and the end of the reporting period, total assets minus total liabilities equal to total equity. The recognized changes in equity during the reporting period comprise income minus expenses recognized in the statement of financial performance, plus contributions from holders of equity claims minus distributions to holders of equity claims. The statements are linked because the recognition of one item or a change in its carrying amount requires the recognition or derecognition of one or more of other items or changes in the carrying amount of one or more other items. For instance, the recognition of income occurs at the same time as the initial recognition of an asset, or an increase in the carrying amount of an asset, or the derecognition of the liability, or an increase in the carrying amount of the liability. Can I give you a simple example? If you make a sale, you are going to either receive cash or you are going to sell on credit. That means you have a data. The data is an asset. Cash is an asset. So, but the sale is income. So the income occurs at the same time as the initial recognition of an asset. Okay. So the income occurs at the same time as the initial recognition of an asset. When you sell, you get cash, or you may sell on a credit and you have a data. So both cash and data are assets. The recognition of expenses occurs at the same time as the initial recognition of a liability, or an increase in the carrying amount of a liability and the recognition of an asset, or a decrease in the carrying amount of an asset. Recognition criteria. Only items that meet the definition of an asset or a liability or equity are recognized in the statement of financial position. Similarly, only items that meet the definition of income or expenses are recognized in the statement or statements of financial performance. Why I say statement or statements, there are two. We have the statement of profit or loss and other comprehensive income, which may form the statement of financial performance. Derecognition. Derecognition is the removal of all or part of a recognized asset or liability from an entity statement of financial position. Derecognition normally occurs when the item no longer meets the definition of an asset or a liability. And for an asset, derecognition normally occurs when the entity loses control of all or part of the recognized asset. And for a liability, derecognition normally occurs when the entity no longer has a present obligation for all or part of the recognized liability. One or more of the following procedures are aimed at after derecognition. 1. Presenting after derecognition, what are the objectives? Presenting any retained component separate in the statement of financial position, presenting separate in the statements or in the statement or statements of financial performance any income and expenses recognized as a result of the recognition of the transferred component, and providing explanatory information. Okay. Measurement. Okay, I could give you an example there before we go to measurement. If you have assets, you may have a structure, a building, which have been recognized as property, plant, and equipment as your asset in the statement of financial position. Now, when you have a structure you are selling, you need to de-recognize it from property, plant, and equipment, and then you recognize it as an asset held for sale. So that means you are going to present it as a separate component in the statement of financial position. That is as per the requirement of IFRS 5, which we shall see in the future period. Okay. And finally, what if you have sold the asset? We are saying that now the disposals, those are now, you need to present them in the statement of financial performance. Okay, if you have gains, those may come through in the statement of other comprehensive income. Or you need to have explanatory information. The notes, they need to accompany your financial statements. State clear that the entity has this piece of land which has been disposed of, or which is going to be disposed of, or it has structures which are going to be disposed of, a plant, stated clearly in the notes. Measurement. Elements recognized in financial statements are quantified in monetary terms And then this requires the selection of a measurement basis. The first one, historic cost. The historical cost measures provide monetary information about assets, liabilities, and related income and expenses, using information derived, at least in part, from the price of the transaction or other event that gave rise to them. So here we are looking at using information derived, at least in part, from the price of the transaction or other event that gave rise to them. The historical cost of an asset when it is acquired or created is the value of the costs incurred in acquiring or creating the asset, comprising the consideration paid to acquire or create the asset plus transaction costs. The historical cost of the liability when it is incurred or taken on is the value of the consideration received to incur or take on the liability minus the transaction costs. The historical cost of an asset is updated over time to depict, if applicable, the consumption of part or all of the economic resource that constitutes the asset, with that, for example, depreciation and amortization, payments received that extinguish part or all of the assets. Okay, when, for instance, you sell the asset, you have extinguished the asset. It's no longer there. The effect of events that cause part or all of the historical cost of the asset to be no longer recoverable, that is impairment. Lastly, accrual of interest to reflect any financing component of the asset. The historical cost of the liability is updated over time to depict, if applicable, fulfillment of part or all of the liability. For example, by making payments that extinguish part or all of the liability, or by satisfying an obligation to deliver goods. The effect of events that increase the value of the obligation to transfer the economic resources needed to fulfill the liability to such an extent that the liability becomes onerous. The liability is onerous if the historical cost is no longer sufficient to depict the obligation to fulfill the liability. And lastly, accrual of interest to reflect any financing component of the liability. Current value. Current value measures provide monetary information about assets, liabilities, and related income and expenses, using information updated to reflect conditions at the measurement date. Current value of assets and liabilities reflect changes since the previous measurement date in estimates of cash flows and other factors reflected in those current values. Unlike historical cost, the current value is not derived even in part from the price of the transaction or other event that gave rise to the asset or liability. Current value measurement bases include fair value, value in use of assets, fulfillment value for liabilities, then current cost. What is fair value? Fair value is the price that would be received to sell an asset or paid to transfer liability in an orderly transaction between the market participants at the measurement date. We shall study more about fair value in IFRS 13, that is fair value measurement. In some cases, fair value can be determined directly by observing prices in an active market. In other cases, it is determined indirectly using measurement techniques. For example, cash flow-based techniques reflecting all the following factors: estimates of future cash flows, possible variations in the estimated amounts or timing of future cash flows for the asset or liability being measured, caused by the uncertainty inherent in the cash flows, the time value of money, the price for bearing the uncertainty inherent in the cash flows, that is the risk premium or the risk discount, which is the price for bearing the uncertainty, and it depends on the extent of that uncertainty. It also reflects the fact that investors will generally pay less for an asset and generally require more for taking on a liability that has uncertain cash flows than for an asset or liability whose cash flows are certain. Lastly, other factors like liquidity, if market participants will take those factors into account in the circumstances. Value in use and fulfillment value. Value in use is the present value of the cash flows or other economic benefits that an entity expects to derive from the use of an asset and from its ultimate disposal. Fulfillment value is the present value of the cash or other economic resources that an entity expects to be obliged to transfer as it fulfills a liability. So value in use and fulfillment value cannot be observed directly and are determined using cash flows-based measurement techniques. So they are not direct observation. They are scientifically determined, okay, but must reflect entity-specific perspectives rather than market perspectives. Current cost. The current cost of an asset is the cost of an equivalent asset at the measurement date, comprising the consideration that will be paid at the measurement date, plus the transaction costs that will be incurred at that date. The current cost of a liability is the consideration that will be received for an equivalent liability at the measurement date, minus the transaction cost that will be incurred at that date. Current cost, like historic cost, is an entry value. It reflects prices in the market in which the entity would acquire the asset or would incur a liability. Hence, it is different from fair value, value in use, and fulfillment value, which are exit values. However, unlike historic cost, current cost reflects conditions at the measurement date. Okay, factors to consider when selecting measurement basis. The nature of the information that the measurement basis will produce in both the statement of financial position and statements of financial performance. Relevance and faithful representation of the information. Whether it is initial measurement or subsequent measurement. Of course, some transactions at initial measurement may be measured at historic cost. Then at subsequent measurement may be measured at current cost. Okay, that is either fair value or value in use. Comparability, understandability, verifiability, and the constraint factors. Assets may be acquired or liabilities may be incurred as a result of an event that is not a transaction on market terms. So if a transaction is not on market terms, it's not fair to use fair value methodology, for instance, measurement basis. Okay. So the transaction price may be affected by, for instance, the transaction price may be affected by relationship between the parties or by financial distress or other duress of one of the parties. An asset may be granted to the entity free of charge by a government or donated to the entity by another party. So you cannot measure it using fair value when it is just, this may necessitate to measure it at a cost, at using historic cost conversion. A liability may be imposed by legislation or regulation. A liability to pay compensation or penalty may arise from an act of wrongdoing. Wow. Chapter 7. Presentation and disclosure. This is the second last chapter. A reporting entity communicates information about its assets, liabilities, equity, income, and expenses by presenting and disclosing information in its financial statements. Effective communication of information in financial statements makes that information more relevant and contributes to faithful representation of an entity's asset, liabilities, equity, income, and expenses. It also enhances comparability and understandability. Presentation principles. Entity-specific. Okay. Information is more useful than standardized descriptions, sometimes referred to as boilerplate. Okay, you do not have to generalize descriptions, boilerplate. You need to give entity-specific description of transactions. Duplication of information in different parts of the financial statements is usually unnecessary and can make financial statements less understandable. Classification. Classification is the sorting of assets, liabilities, equity, income, or expenses on the basis of shared characteristics for presentation and disclosure purposes. Classifying dissimilar assets, these are ones which are not similar, liabilities, equity, income, or expenses together can obscure is to hinder, kind of to obscure relevant information, reduce understandability and comparability, and may not provide a faithful representation of what it purports to represent. Classification is applied to the unit of account selected for an asset or liability. However, it may sometimes be appropriate to separate an asset or liability into components that have different characteristics and to classify those components separately. For instance, separating an asset or liability into current and non-current components and to classify them separately. Offsetting. Offsetting occurs when an entity recognizes and measures both an asset and a liability as separate units of account, but groups them into a single net amount in the statement of financial position. Offsetting classifies dissimilar items together, and it is therefore generally not appropriate. So offsetting assets and liabilities differs from treating a set of rights and obligations as a single unit of account. Classification of equity. To provide useful information, it may be necessary to classify equity claims separately if those equity claims have different characteristics. For instance, share capital, preference shares. Ordinary share capital is different from preference share capital. The characteristics are different. You may present them separately on the financial statement, on the statement of financial position. Okay, and also in the statement of what? Changes in equity. Also, it may be necessary to classify components of equity separately if some of those components are subject to particular legal, regulatory, or other requirements. For instance, distribution to holders of equity claims are only made if the entity has sufficient reserves. Hence, presenting or disclosing those reserves may provide useful information. Distributions to holders of equity claims, here we are referring to dividends, paying dividends to shareholders. Okay, of course, in several jurisdictions, you only pay dividends out of the available profits. So what they're saying here, yeah, it is very, very important that you disclose the profits which you have paid dividends from. So sometimes the dividends may be proposed and may not be paid. Okay, you need to have evidence of the earnings. So the earnings may be required to be presented separate, the retained earnings. But those ones are obtained after deducting expenses from incomes in the statement of financial performance. So those earnings may be recognized in the statement of changes in equity. Classification of income and expenses. Classification is applied to income and expenses resulting from the unit of account selected for an asset or liability, or components of such income and expenses if those components have different characteristics and are identified separately. For example, a change in the current value of an asset can include the effects of value changes and the accrual of interest. It will be appropriate to classify those components separately if doing so would enhance the usefulness of the resulting financial information. Profit or loss and other comprehensive income. Income and expenses are classified and included either in the statement of profit or loss. We some people call it profit and loss. You know, you cannot make profit and loss at the same time. So it is appropriate that you call it profit or loss and other comprehensive income. But if you say profit and loss, although the framework does not expressly discourage or restrict that, but the statement of financial performance is either reflecting profit or loss, but not both. Okay, so it just it appears more relevant when you call it profit or loss, but there's no restriction. Okay, profit or loss or outside the statement of profit or loss. So that means there are two statements. You could put it in the profit or loss or in the statement of other comprehensive income. We shall see this more in the next chapter, IS1, which we are going to be studying in detail. So the statement of profit or loss is the primary source of income about an entity's financial performance for the reporting period. Aggregation. Aggregation is the adding together of assets, liabilities, equity, income, or expenses that have shared characteristics and are included in the same classification. Aggregation makes information more useful by summarizing a large volume of detail. However, aggregation conceals some of that detail. Hence, there should be a balance between relevant information not being obscured, either by a large amount of insignificant detail or by excessive aggregation. So different levels of aggregation may be needed in different parts of financial statements. For example, typically the statement of financial position and the statements or statements of financial performance provide summarized information, but more details of the information are provided in the notes. Chapter 8 of the Conceptual Framework, which is the last chapter of the Conceptual Framework, is concepts of capital and capital maintenance. Concept of capital, financial capital maintenance. Under this concept, a profit is earned only if the financial or money amount of the net assets at the end of the period exceeds the financial or money amount of net assets at the beginning of the period, after excluding any distribution to and contributions from owners during the period. Financial capital maintenance can be measured in either nominal monetary units or units of constant purchasing power. Physical capital maintenance. Under this concept, a profit is earned only if the physical productive capacity or operating capability of the entity or resources or funds needed to achieve that capacity at the end of the period exceeds the physical productive capacity at the beginning of the period, after excluding any distributions to and contributions from owners during the period. The physical capital maintenance concept requires the adoption of the current cost basis of measurement. And the financial capital maintenance concept, however, does not require the use of a particular basis of measurement. Capital maintenance adjustments. The revaluation or restatement of assets and liabilities give rise to increases or decreases in equity. While these increases or decreases meet the definition of income and expenses, they are not included in the income statement under certain concepts of capital maintenance. Instead, these items are included in equity as capital maintenance, adjustments, or revaluation reserves. Don't mind about capital, concepts of capital and capital maintenance. This is a chapter of the Conceptual Framework which was not revised as per the 2010 Conceptual Framework. So if you had the knowledge about the 2010 Conceptual Framework, you may maintain that. Thank you for your time. We are ending here for today. Our next unit will be on IS1, presentation of financial statements. See you then. Take care. Maintain standard operating procedures and protect yourselves from COVID-19 and other variants. Good night.